Thanks a lot, Miha. This is Steve Okot. Thanks everyone for joining this webinar. All our clients and the people whom we do business with are all welcome to this particular webinar. And the main point why we are sharing this is to share with you our insights in regard to the recent developments in international tax and transfer pricing in the country, and some of the strategies that can be adopted to be able to manage this and also to manage the risks that are coming out. So I'll go straight to the point, but I'll be joined by my two colleagues, Mark Castello, who is coming from South Africa, or BDO in South Africa, and Magdalene, who is here with us in our Nairobi office. So obviously, the three main requirements, and in addition to the emerging developments in international tax, other jurisdictions like South Africa are already 3 or 4 years ahead of us in regard to these requirements. And so Marcus will be sharing the experiences of businesses in South Africa in dealing with these challenges. So we have master file requirements to be filed with the Revenue Authority. We have local filing requirements to be filed with Kenya Revenue Authority. So local files we all have, or multinationals or companies with cross-border transactions already have local files. This is what we call transfer pricing policy document. Most of you already have this documentation in place, and many of you are already adhering to its contents in your transactions on a day-to-day basis. And so that is something you are already familiar with. The only addition that came in last year to be adhered to from this year going forward, the only addition is that at some point, this has to be filed with the Kenya Revenue Authority in the standard format, which is set for that particular compliance. So you are going to have to disclose part of your transactions to Kenya Revenue Authority by way of a return. Now, this is something new, and it's coming with additional compliance challenges and implications for your business, which we'll be addressing. Then we have master file and country-by-country reporting, which will be completely new for most businesses and most companies. And of course, there are also additional developments that are coming in, and I'll be addressing them together with the challenges that are being faced by companies in complying with the international tax requirements. The recent strategies that are in place, those who have gone through transfer pricing audits recently know this, or the additional requirements by KRA, the aggression that the audits are coming with, the additional information requests and sign-offs that are being demanded. This is becoming something of a challenge. So we'll be addressing this in addition to the customs challenge, the entities that import a lot, especially in the manufacturing space, are facing a situation where there is a conflict between transfer pricing requirements and customs department requirements, and how to marry that and how to manage this potential conflict and what its implications to your business are. So this is the summation of the webinar today. And my colleague Magdalene, after we've highlighted these developments and their impact on businesses and the strategies to adopt in order to mitigate this, Magdalene is going to address the actual practical elements of these requirements, and hers will be the last session. So I'll go straight on to my session, beginning with what is this all about? So transfer pricing, of course, is important for governments, or it's important for businesses for many reasons. One, governments are guarding their revenue. They want to ensure that they are getting a fair share of the revenue from the business operations of multinationals. So companies with cross-border or transactions, or branches, subsidiaries, related parties doing businesses with each other on transferring monies and goods and services across the borders. This is something of interest to them because the bulk of global trade is actually between, in terms of US dollar terms, more than 65% of global trade is between related entities across the globe. So everyone is trying to protect their revenue base. This is the reason why this really came to be. And that's why KRA and other revenue authorities are placing a lot of emphasis on transfer pricing and other international tax requirements. Now, the other reason of concern is that transfer pricing and international tax generally is a complex area of tax. It is a challenging area of tax. It's not your day-to-day VAT, and it's not your day-to-day other tax compliance obligations. For one, there are many rules that you have to look into in order to design the ideal or transfer pricing treatment of your related party transactions. When you are selling goods to your related entities across the border, or when you are buying goods or raw materials from your related parties, this is something that you have to really consider. Now, we have Section 18 of the Income Tax Act, which sets out the rules on transfer pricing. This is the requirement for the arm's length standard to be applied in this transaction, in that when you are dealing with your sister company, when you are dealing with your parent company, those transactions need to be priced at arm's length. They need to be priced and the terms need to be set in the manner which will be conceived or which will be consistent with the reality out there in the market between two entities that are not related. So this is Section 18 is the main section of the law that brings into place these requirements. And then we have the transfer pricing rules, which are set out as under legal notice attached to the Income Tax Act and pursuant to that Section 18.3, which you also have to look at. And then we have pronouncements that have been put forth by the judicial bodies, by the courts in Kenya and also courts globally, that to give meaning to these transfer pricing rules, you need to look at the OECD material. And the OECD materials, we have OECD transfer pricing rules, and we have the OECD Model Tax Convention. So those also have to be looked at. Then among the OECD material, you also have, when you are dealing with a situation of head office and the branch, you have also the OECD guidelines on attribution of profits or income to permanent establishments, which you also have to look at. Then now we have the situation of country by country reports that have to be filed, master files, local files. Tax Procedures Act has already put into place these ones. Then we have conventions like double tax treaties that have been signed by Kenya, which also have to come into effect, and rulings which have been given by the Tax Appeals Tribunal, by the High Court, by the Court of Appeal. So international tax and transfer pricing particularly is sitting in a situation of technical complexity. So this is also the other challenge that is there, why critical attention needs to be paid to this subject. It's not like the VAT where the rate is 16 and you call it a day. Now, subjectivity of the subject, subjectivity of the topic, and this subjectivity manifests itself in tax audits when KRA is conducting revenue audits. That subjectivity is evident because a departure from one transfer pricing or method to the next, a departure from transactional net margin method to profit split or to cap, could have significantly different realities in terms of the economics of it, in terms of the tax or effect. So that also, this subjectivity and the ability of shifting is also a challenge. And that's why diligence and rigor have to be, the operating or formula in regard to international tax and transfer pricing. You cannot ignore structuring, you cannot ignore documentation, you can't ignore evidence, you can't ignore support, and you cannot ignore attention to transfer pricing audits. Now, The other issue is profit shifting. This is more of a concern to revenue authorities, especially when they are dealing with aggressive tax planning or strategies that have been put in place by multinationals. Of course, the correct thing to do is to optimize your tax position as a multinational, as a business. You have to take advantage of the law to maximize returns from the business that you are conducting. But this brings us into the situation where many multinationals are attempting to shift profits from countries with high tax rates like Kenya, 30%, to countries where the tax rate will be much, much lower, will be 15% in the case of many European countries, or it could be much lower in the case of international financial centers like UAE and Mauritius, Seychelles, you know. So that also is a challenge that's a problem for revenue authorities. Now, the other problem which has cropped up in the arena of tax is the issue of tax activism. So you've seen people like Tax Justice Network going to court, pressing governments to enact more aggressive or even egregious or tax measures. and this is a challenge because they are wielding a lot of force. They are wielding a lot of political will in the area of tax. And from my experience, I can tell you, these people do not know the realities of business and the realities of tax. So these are the issues that multinational entities are now dealing with in regard to international tax. I'll go straight to the point because at the end of the day, it comes down to money. It comes down to risk. It comes down to tax. I'll go straight to the point because there has been recent aggressiveness in transfer pricing audits, especially in the last 2 years. It has become more aggressive. It has always been aggressive, but in the last 2 years, it has become more aggressive. More and more companies are receiving demands to present their transfer pricing policy documents. They are receiving inquiries in regard to their related party transactions. They are going through audits and assessments are being issued. And some of these assessments are merited, and the quantums that we are looking at are huge. We are looking at 10 billion Kenya shillings, 30 billion, 50 billion for larger companies. We've seen this kind of assessment. So this really prompts us to conduct this series of sensitization to really say that this is what is happening and this is the preparation that you need to put into place. I've summarized on a single slide because many CEOs requested me that I need to be able to summarize the key issues so that they can pay attention to them without going through volume. So I've summarized all this into a single sheet and I'll be sharing them out after this particular webinar. So I'll go straight to the first issue, and there are 8. The first issue that is now emerging is the issue of how TP audits are being conducted. It's no longer about looking at contracts and transfer pricing documentation and invoices and ledgers and audited accounts, and then people going through workings and worksheets. They are now conducting interviews. They're asking for the list of staff members and they're selecting at random and interviewing staff, asking them, what kind of activities do you do here in your day-to-day work? And what kind of work does this particular local entity do? They are asking that those particular conversations be mediated and signed off. And this is a big problem. So I have an entire slide just on the issue of interviews and documentation. So the biggest risk in terms of the interviews that are being conducted during audits to all staff is that there is likelihood of wrong information being presented to KRA. And when that wrong information is presented, it's likely to be used against the company, to the jeopardy of the company. So this is an important issue. Now, well, under the Tax Procedures Act, Kenya Revenue Authority has the powers to request for information and to be able to interview anybody. This power is available with the commissioner. Now, the way these interviews are being conducted, the objective is to raise additional taxes or to recharacterize transactions. And from my experience, people tend to exaggerate the work that they do. So the solution here is to ensure that people are prepared for these interviews and they know the delimitations of their job. It is strictly as per contract, and it's strictly as per what they do on a day-to-day basis. The risk of what they will say has to be properly captured. In fact, they need to be prepared as if they're preparing for a court cross-examination or for a tax appeals tribunal cross-examination. They really need to respond correctly and within scope and accurately, and not go beyond the limits, because wrong information can lead to wrong assessment. So this is the issue of cross-examination. It's a major area of risk, and many people are feeling uncomfortable with it. But the provisions of the Tax Procedures Act is that this power is available with the commissioner. The cure for it is to prepare. Now, this brings me to the issue of the people who have left the organization, or the people who will leave the organization. Everybody will at some point leave every organization. And you find that the transfer pricing arrangements were already put in place, and with the finance team or with the management team, which was in place 5, 6, 7 years ago. You can imagine when those interviews were not actually captured in minutes, they were not signed off on, and then they are the basis of a transfer pricing policy document. So going forward, we're asking that during the preparation of transfer pricing audits, we normally conduct interviews. These interviews will have to be minuted and signed off and put in the file, such that they can be used at a later date when Revenue Authority comes in. You can be presented that these are the minutes that were actually taken during the time when the TP documentation was being prepared. And this calls for a review of TP documentation, transfer pricing policy documents. We all know that the review needs to be conducted every 3 years, or when there are additional transactions that the entity or the group is conducting, or when there is a massive economic change like the way we had COVID-19, or when there is a massive change in economic circumstances, you have to take it through. And when there are additional transactions, you also have to review it. Now, during those reviews, we will be requesting that interviews are again conducted and they are minuted and signed off on. This is just to prepare or in the case there is a transfer pricing audit. Now, documentation threshold is no longer going to the database or TP Catalyst, OneSource, royalty range, and just pulling out and relying on that. The documentation that supports the TP document now has to go to the websites, to the analysis of websites of the comparables that are selected to benchmark the transaction in question, or industry reports and other materials. This is becoming quite critical in the defense of TP positions. So these are some of the risks that are there. They are emerging, and these recommendations are the best way to manage them. Now, there are other areas of risk that are picked of branches and service subsidiaries, because we are seeing them coming under a lot of pressure, especially from an assessment perspective, letters of finding. Most of these entities are compensated on a net cost plus basis. Transactional net margin method is the method that is preferred in most of the cases. But this method is coming under scrutiny, and we are seeing preference by KRA for profit split or cap. They don't apply them correctly, so I have to be very open or in my professional view, or this characterization has not been merited. And my view is that this is going to go into disputes, and they will lose quite a bit of them. But by the time that comes, a lot of pressure shall have taken place on the business, and a lot of stress shall have been consumed. So the name of the game is to ensure that functional analysis is done correctly and reviewed, because they are going by functional analysis. They interview people and then they say, no, the scope of the service is not the way it is in the TP policy document. We've interviewed all these people, and it's actually much broader. Instead of normal services, these are technical services. Technical services are compensated at a much higher margin, 15%, and you used 7% for the normal administrative or support services or sales support services. We've seen CAP being conceived for the local sales subsidiaries or local sales and marketing entities, where they're saying, no, you needed to have presented a commission, and the commission for this kind of sales is 5%. So these are some of the challenges that are coming for services or for branches and service subsidiaries. Also, construction entities, Chinese entities, Indian entities, European companies that are conducting projects here through branches, they're coming under a lot of pressure from a transfer pricing perspective. So these are the realities of what is taking place. And the best practice in terms of responding to them is to review documentation and to review preparation, because also in our experience, where documentation is robust, most of the time it doesn't proceed to even a letter of findings, it's dropped. So the documentation has to be so tight, because you will spend a bit of time in documentation, but it will save you much more time in dispute resolution. So the first port of call is documentation and implementation of the documentation. It's not just about having a good policy document and then failing to implement it. So this is the first step. The second step is the preparation that I mentioned, having your team prepared for this kind of possibility, and having a proper review to map out what risks will be there. So these are the areas that are really coming under a lot of pressure. I'll go to the other issues. One, compliance. You really need to retain good people. Don't release good people, and then you don't have people capable of handling a KRA audit internally. This is an exercise that no longer can just be left to the tax consultant. You need to have a good, robust team. Your documentation needs to be proper. Your accounting records, invoices, ledgers, all these have to be properly maintained. It's not uncommon for us to go or to support a client on a transfer pricing entity, and they don't even have invoices relating to related parties. So compliance system needs to be placed to be in place. I've mentioned about reviews for every 3 years and comparability updating every year. These are things which do not come at any material cost or effort, but they can save for the day when it comes to a situation of risk management. And always preparation is better. Comparability I've also spoken about. And then there is the issue of substance. Substance where trading entities, particularly KRA, disputes that the sales team, which is based in Mauritius, is actually adding no value, or it's just one lady sitting there and generating invoices. This entity cannot retain 5%, or it cannot retain 10%. So the issue of substance and content is coming into being, and it's something that can be managed technically, but there has to be also frankness in this. Some of the structures that people have really don't have substance, and this is something that has to be confronted. If you are to change it, it is better to change it now than to change it 3 years ago, or attempt to change it 3 years to come when there is a knock on the door. Now, I've mentioned that we are not in this alone. all these developments, in addition to including new taxation of branches, which is good, or including restriction of interest expense, all the other developments that we will not be mentioning today, but have come through in the taxation regime in Kenya, restriction of FX losses claim, all this. We are not alone in this. Kenya is not alone in this. It is part of a global movement that is taking place. And this global process started in 2008, when there was the great global economic recession. After that, President Barack Obama and the US government indicated that multinationals were really evading taxes, shifting profits, and generally just leaving the burden to society and taking the profits and rewarding shareholders and top management with the dividends or bonuses. And, they're just prospering at the expense of everybody. So this has been a trend from that time onwards. So we had BEPS, then we have BEPS 2 to reduce the process of shifting profits to low tax jurisdiction. Then we have an overhaul of the transfer pricing guidelines. And now we have Pillar 1, we have Pillar 2. Pillar 1, the goal of Pillar 1 is to ensure that you don't just operate in some small island in the middle of the sea and then you generate a lot of profits because you are a technology entity. You also have to put some of those profits under taxation in the countries where you are generating income from. So that's one, Pillar 1. Pillar 2 is now where we are now more worried about, because they are saying we need to move to a situation where we have a global minimum tax rate for multinationals of 15%. In the event you paid less than 15%, you have to top up. Then there is a top-up tax. These proposals have not seen the light of day because the United States government have not yet jumped on board. All European companies, European countries, or most OECD countries are already on board with these proposals, but the US has not yet joined. It's a major economy in the world, and without it joining, or these recommendations have not seen the light of day. But our estimation is that they are going to see the light of day. There is also a discourse that is taking place at the developing countries level, and Kenya is a participant. We are participants in this discussion about the issue of special economic zones, export processing zones, or which entities that are enjoying tax holidays, special operating frameworks, are they going to be affected by the 15% or minimum tax? And yet they are operating in preferential regimes in developing countries. So these are things that is still in the lobbying process. How will this be affected? Will African countries be exempted from this, or this global minimum tax has to really go through? So Kenya is not alone. So it's not an isolated issue of aggression by KRA. Or transparency, which is an ugly word for most multinationals. Transparency is an ugly word because when you hear about transparency, it means even your trade secrets may be in jeopardy. So these are things that are not comfortable to people, but it is the reality of the day. Exchange of information between countries. KRA is already exchanging information with UAE, with UK, with different revenue authorities across the globe, or based on the multilateral convention for exchange of tax information, and based on information exchange protocols under double taxation treaties that Kenya has effectively. So this already is there. And what is the implication of this exchange of information? We know the culture here. We know the situation where we live in here. This information is not being asked for innocently. KRA is asking for this information to do a risk profiling. Where is the opportunity to raise additional taxes? This is the culture here. So we have to be very frank about it and say that automatic exchange of information is going to be used for scoping who is to be audited or who is not to be audited. That's the reality. Information exchange protocols are going to be used for the same issue. And so we have to confront this and indicate that these are risks that we are facing, but it's not localized to Kenya, it's global. I've mentioned these particular requirements. I mentioned these particular requirements of master file. I'll go straight to brief this. This requirement is already in law from this year. Or local file, this has always been there. The only difference is that now you have to upload your related party transactions on the return itself, the income tax return. So if you go to the CVS file on Excel, this requirement has already been updated in the income tax return, in the IT2C. So it means from next year, a summary will automatically be submitted to KRA. So next year when people are filing, a summary will automatically be submitted to KRA, and they will use that information for risk profiling. Country by country reporting is only for entities that belong to large multinational groups, and it might not be a concern for some people, but for most, it is an implication, especially our large clients. This is something we are working on. And the information that is to be collected using these materials, master file, local file, and country by country reporting, this information is going to be used for risk profiling. And when there is a lot of inconsistency of information, it's going to result into a tax audit. So there is a greater need for alignment of information. The information that we have here, the treatment of transactions between parent company and the subsidiary in Kenya. Is it the same as the treatment between the parent company and the subsidiary in Uganda, or in Tanzania, or in DRC, or in South Africa? Inconsistency of information is going to be a risk area. So these documentations have to be looked at in totality, so that there is a greater alignment. That is really the point to take home, that there is great alignment of all these documents, local file, master file, country by country reporting. The information across needs to be aligned so that there is no great inconsistencies, because those inconsistencies are going to invite a revenue audit. And this is not something that you willingly invite, but it is something that you must deliberately prepare for. Now, I've already mentioned that on the CBCR report, the guidelines are already out, and you can look at them. The package of information that is to be provided is already in a newsletter. We had already shared, and my colleagues are going to again share this to the people who have attended this webinar, so that you can see in greater detail what kind of information you are looking at. And Magdalene is going to go into the practicalities of this particular requirements. I mentioned about this FX restrictions, and I've mentioned about master file and local file, the information to be provided. And the key risk to take home is that these are areas that you need greater scrutiny of information. I want to mention something before I go to the next stage. One, there is trade secrets and business strategies that different business groups implement. This is something that now has to be seriously considered, because this package of returns that are to be filed with KRA is going to place a challenge to those particular arrangements. And that is something that a conversation that people need to begin having within the group, within a business group, head office and country office needs to start having those conversations. If this information is going to go, who is going to access this information? Who has control of this information? Who ensures the consistency of information which is being provided? Who ensures that if we have a multi-jurisdiction audit or exchange of information, the correct information is going to be presented? That is a conversation that you have to now have internally first before you come into a process of review, because it can be quite uncomfortable. And this is based on our experience. Now, I have to come to the issue of preferential tax regimes. And on this, from a legislative perspective, we are speaking from both sides of the mouth. One, we are challenging the situation where we have entities in Kenya dealing with their related parties or non-related parties in preferential tax regimes, countries with a lower tax rate than 20% and all that. But at the same time, we are presenting the package of incentives to facilitate investments into our own preferential tax regime, which is the EPZs and SEZs and special operating frameworks and affordable housing programs, entities or environments which enjoy a preferential tax treatment. So this is something that now presents challenges, different challenges to different taxpayers, to different businesses. If you are doing business with companies in Mauritius or companies in Dubai, you have additional factors to consider in the event this is challenged as a preferential tax regime. Now, if you are operating in a special economic zone where the tax rate is 0% for the next 10 years on foreign earned income, the EPZ where you have a tax holiday and all this, the issue is if you are trading with related parties which are not in those regimes, you have to ensure that you have a transfer pricing policy document in place and that the transactions with those parties is at arm's length. So it is not just transactions with non-resident entities that are subject to transfer pricing requirements. When you go to Section 18, also the preferential tax regime. So if you have your EPZ company here in the region, maybe is doing processing of different goods, or maybe it is a service special economic zone which is servicing you here and also servicing all your operations across Africa. These are some of the entities or structures that we deal with. So in that case, you have to ensure that there is a TP policy in place and that you are adhering to it, because these are even lower hanging fruits because they are both within the information regime that KRA administers. So KRA can request an EPZ or an SEZ company or a special operating framework company or an affordable housing project company for information, just like it can request for the sister companies which are normal entities in the market. So you have to ensure that things are just tight and you don't fall afoul by thinking that this was just something for transactions with non-resident entities. So I'd already mentioned about transparency and substance at the onset, and this also probably the only additional point that I may want to make is that it's two ways. There are also businesses which are located outside the country, but KRA can deem them to be having their effective place of management in Kenya, where all the top guys are in Nairobi, all the key guys, crucial guys are living here in the city, but the entity is taken to be based in Singapore. So this is likely to be a situation where it is said that substantively the income is supposed to be earned in Kenya. That's a structuring issue to address. Now, I have to go to the other emerging problems. For those who do not know, customs audits are a pain in the neck. They are a pain in the neck They are not like domestic taxes audits. These ones are a pain in the neck because the scope of skills and the scope of time and the scope of attention that customs officers have to invest in an audit or in an inquiry is much less than what domestic taxes people have. Sometimes situations arise where the goods are already at the port and they have to be cleared, and then there is a dispute as to the valuation. So you are already incurring cost and accumulating cost, or when storage charges, demurrages are already piling up, and you have a customs issue you are dealing with. That is quite a gun on your head because you don't have the full 60 days, 90 days to address the dispute. You just have here and now. So when this arises, it is a problem. And we are finding situations where transfer pricing is okay, it's disputed by customs, or customs and transfer pricing, or the customs treatment is different. So you have to ensure that the treatment of transactions is aligned for transfer pricing and for customs purposes. And that is also still not enough. You have to be prepared to explain and elaborate this to revenue authorities. Now, this is an emerging area where we are having a situation of TP and customs. I think that really is the nutshell of it. I've provided quite a bit of material as to how this arises and how to address it. And you are going to have to go through this yourselves. The areas of risks, royalties, all this is under a lot of scrutiny in PCA audits. So at this point, I'd like to invite Marcus Taylor to take us through the experience of South Africa with this kind of new developments, because they are ahead of us by a factor of about 3 years. So the experience of businesses, because for us, we are anticipating risk and we are preparing for risk, but for them, they have gone through the risk. Marcus, welcome.
Thank you, Steve. I just need to share my screen. Can you see this, Steve?
Yes. Could you please put it on presenters mode?
I'm trying. Sorry, the top. Oh, yeah, there we go. Let's place it. There we go. Is that working for you?
Yes, that's good. Thanks.
Brilliant. Thank you for confirming. So thanks everyone for having me. My name is Marcus, as mentioned by Steve, and I sit here in the South African office in Johannesburg, and I have the pleasure of just taking you through some of the experiences that we had in relation to the master file, local file, and CBCR. And I think a lot has been going on in your area. We've been dealing with it actually a bit longer, Steve, than just 3 years. From memory, it came in around 2018 when we had to start discussing these elements and start filing some of our documents. Obviously, a lot of the requirements around, when you file and how you file may differ to that of in Kenya, but I think there's obviously a lot of learnings that we certainly have, and I wanted to take you through some of them, and I put them into different discussion topics, and then I'll take you through each one, and I'll obviously then have 5 sub-points here, as you can see. And with that, please do share your questions. If I'm missing anything or you would like to elaborate on something, I can do so after the presentation. So firstly, understanding the new regulations, why are we here? And Steve had a very nice session at the beginning of this webinar around, where it all came from. And Steve also mentioned this word transparency, which I do understand that Steve doesn't think it's a great word to use for multinationals, but there's always 2 sides to the coin, and I will mention the advantage of it shortly. But yes, the reason why we're here is transparency. Tax authorities were thinking that taxpayers are hiding a lot of information, or they do not have the information. In South Africa, for example, we noticed that a lot of the subsidiaries, when they were asked to provide information to the tax authorities, they may argue that I do not have access to this kind of information. I cannot get this information. So I think, for example, of a service charge coming into South Africa, in your case, Kenya, that service fee was calculated in a certain way. And in order for a tax authority to determine if that way was arm's length, You would need to consider the cost base, the markup, the benefits test, and all those good things. And what the subsidiaries in South Africa would do is they would say, well, I don't have access to the information. I can't give it to you. You need to just accept it, to which obviously our tax authorities continuously said, we cannot do that. They would then disallow the charge. And then what we would notice is then all of a sudden this information would become available. And this is something that the tax authorities are trying to combat with the new regulation, so that you would have to have this information available at the time of filing. Which brings me to that point on the right-hand side, which talks to test arm's length. So Steve mentioned that, the local file is similar to a transfer pricing policy in the Kenyan context. In South Africa, that was very different. A policy in our context in South Africa was a document that provided you with the methodology and the way of how to get to an arm's length price or fee, or however you want to look at it. However, what a policy in a South African context did not do, it did not test the outcome of a specific year of assessment, whereas the local file does. So if I had to put into an example, a local file would be for a specific year of assessment, or call it a financial year end. And in that document, you would need to now say that the transaction is arm's length. Furthermore, your numbers that you use, coming back to the services example, if that charge was 100, you would need to show the 100. You would need to show that the markup of 5%, was maybe 5, and you would need to show how you got to the 95 and the cost bucket analysis. You couldn't just say, if you charge a cost plus 5%, you're fine. You would have to show the invoice value. That invoice value needs to reconcile to the financials. Those financials then are shown, or the numbers in those financials are also shown in your local file, and all of that had to reconcile. And if it didn't, you would need to provide evidence in the local file why it didn't. So again, that was also part of why we're here now, because it just provides much, much more information coming back to the transparency element. Another point that we notice is that back in the day, you would have been able to give some information in South Africa, and then let's say the other side of the transaction is in Kenya, you could have provided different information, keeping both tax authorities comfortable. But what that really meant is you're not talking to the same picture, which obviously created issues from a tax authority's perspective. But now that we have to do, for example, the master file, both tax authorities will get exactly the same information. We talk to the risk identification now. That is why we're here, the country by country reporting. I'll leave that at that. And then the last point is the public confidence, and that we obviously need to align our tax practices with economic activity. So Steve did mention the argument around substance. Next, so I'm just trying to make sure that that comes, compliance challenges. So the next point of discussion is the compliance challenges. And I hope I'm not repeating too much there, because again, Steve had mentioned some, but what we have noticed when we started the process of collating information and starting to populate our local files and master files, and also the country by country reporting, is that our accounting systems were not set up for that. So in other words, you would have seen what goes into a country by country report, for example, cash tax payable. How many of you can say that if I click a button on my accounting system, my ERP system, whatever you may use, will give me that number, and I'm confident that that number is correct? I don't have to go back and ask some financial director or financial manager what that number is, nor do I have to look through 3 different types of Excel spreadsheets, but I'm comfortable that my accounting system can provide that information. I mentioned on the local file the reconciliation between the financials, the invoices, the cost bucket analysis, and all those things. Are you comfortable that if you look into your system, that that will all align with the different services that you've allocated to the different multinational entities? From our case, we saw it is not always the case, and we take a lot of time to get that right from the outset, which means a lot of time is actually not always used to draft the documents, but it's actually to get this part right specifically. There will be increased administrative work. So talking around the challenges, firstly, you probably need to figure out how to file it. That took a while. I've got some, practical, call it war stories I can tell you. For example, one around country by country reporting was that when CBCR came out the first time in South Africa, the way it was set up on what we call e-filing was slightly different to how it was meant to be set up if you followed the OECD guidelines. And what that meant is you couldn't just plug and play technology from overseas. You had to create your own software if you wanted to automate this. And that resulted in a lot of taxpayers or clients of ours actually incurring additional costs trying to get this right. And here the issue was that once it did come right, SARS managed to change some of these disclosures. So they would just change a a box. If you think of RT, if you think of a tax return from a CBCR perspective, there was just a box that was deleted. But what that meant from an RT perspective is you had to recode the whole thing of how to file a CBCR automatically. So there's a lot of stories around from the initial implementation of the returns on e-filing to where we are now and how that has changed and how that can be quite costly if we get it wrong. You will need to, and Steve mentioned this as well, you will need to train up your people, or you will have to identify skills, and you need to have certain additional specialized skills to really get this right. And we see a lot of challenges initially, which we still starting to iron out, but they're getting there, to actually align your economics with the agreements and your tax. And by that we mean, have you noticed that not always your agreement says exactly what you say in your TP policy, and it's not always exactly what happens on the tax return? Now with these new requirements, that will come apparent, and you need to make sure that that does all align. Otherwise, you will have a lot of questions from the tax authorities. And then lastly, a challenge that we face a lot is the additional deadlines. I think Kenya has a 6-month deadline, which I find very quick. That will come around before you know it, because your financial statements are usually signed off within 3 to 4 or 5 months. That gives you maybe a month or two to just align your local file and master file, which is very, very quick. In South Africa, we have 12 months, and we still sometimes go over that. Next, I just wanted to talk to the strategies that you can use for the effective adaptation. I already talked to your accounting system or the ERP system, so that is certainly something that one needs to look at. Does your ERP system provide you the information that you need, but also that you trust? If that's not the case, certainly you want to look into that technical solution, and you're wanting to align that to what is available. And obviously, you also want to automate the process. So when it comes to a country-by-country report, which we see more of a compliance issue, you want to be able to push a button and get the numbers out there and then fill out that report. You don't want to sit there too long trying to find the numbers, going through many different Excel spreadsheets. AI is one of those hot topics. That's why I thought I put it here. When we draft these documents, we try to use, your ChatGPTs as much as one can, and maybe that's not AI in the sense of the word, but long story short, technology is there to help you do a lot of your documentation, but also it is not there yet that you can fully trust it. So you need to find that balance of, what can you get out of a technology solution versus what is needed, and how can you combine the two? You need to think of, are you going to hire more experts? Are you going to put them internal? So what I mean is, are you going to bring them into the business, have additional salary costs and all those other things that go with it? Or are you going to think of this to outsource it, which could initially be a higher cost, but throughout the next couple of years, that might then come down as soon as you understand the processes and your software is up to date and all those things. So that is certainly something you need to think about and consider as well. Restructuring certain business processes, this is an interesting one. I put GVC there, which stands for Global Value Chain. Here you need to really think, if there is issues, and Steve mentioned it as well, if you have issues now with a post box in Mauritius, we like to say in South Africa, and there's nothing really happening there, but you're leaving a cost plus 5 remuneration on that side, that's not going to work. Someone is going to pick that up very easily on the CBCR. Someone is going to pick that up very easily on the local files, or even the master file, depending on how you word it. And that's not going to work anymore. So you need to actually start looking into your value chain already now to figure out what is or maybe is not acceptable, and then fix it now before you have to share all that information with the tax authorities, and they're going to come to the same conclusion, but they may hit you with those penalties. So you can also now start aligning your files through the multinational enterprises. And by that, what I mean is your master file, obviously you will do that once, and that should be then shared depending on if you share it yourself with the tax authorities, or if the tax authorities share it between themselves, that should be fine. From a local files perspective, you now have the opportunity to make your files look very similar. So you can have certain entity files, you can create certain transaction files. So there is some, benefits here in the sense of that. Previously, maybe a South African policy and a Kenyan policy required different things, and they were looking differently, and you had to put in different efforts. Where we are now in the space is that the local file that most regulations now refer to are following the OECD BIPS Action Point 13, and really it's a list of stuff that needs to be in there. And if that is the case, you can actually use a lot of the information that you do in different jurisdictions, and you can run it centrally, which is quite nice. So that certainly should be part of your strategy as well, to just think, how do I do this best to save on cost and have efficiencies? And then, you can manage your arm's length prices now proactively. And by that, we mean you actually finally know what is arm's length, what should be arm's length, talking to the customs element as well. We saw that when you manage this right, and you manage pricing going forward rather than looking backwards. So to give you an example, you realize that your operating margin is running too low, you can then change the prices going forward to get your operating margin back in an accepted range. That means overall for the year as a whole, you may be able to manage both customs as well as arm's length issues. But certainly because you now are more transparent, you are able to see within the business what is going on, which will assist you with some of these issues. Next, the cost implications. I think that is always a very interesting topic because it's easy from our side, I guess, to create these things, but it's a different story when you actually look at the cost benefit analysis. So you need to certainly consider your costs in relation to hiring experts versus the staff cost. And I alluded to that previously. Does it make more sense to have a TP manager in your group tax team? Or does it make more sense to just outsource some of that information in such a way that, it's an annual cost, fair enough, but at least, you're in it for a certain amount and not more than that. A big cost that we see initially when you set this up is actually the time of the executives. So that's probably similar to any sort of transfer pricing audit. But to get this documentation in a way that is acceptable to the tax authorities, you need to spend quite some time on the value chain. And then, as you will know, in the master file, there's certain requirements around financing and your RP to really get the DEMPI analysis, as we call it, for the RP right. It is going to take you some extra time initially to look into that. Consider costs for non-submission. So I mentioned the 6 months, it's very quick. So you may want to consider what would it mean for you to turn that around in time, and if you can't, what does that mean? So it's just something to think about. What are the penalties in Kenya when you get this wrong? In South Africa, we got quite high penalties. If you're on the wrong side of the law, it can be up to 200%. Most of the times it's more around the 50 to 75%. But if you have good TP documentation, in our case in South Africa, you can even get that further down to 0%. So it's certainly something to think about your penalties. If you have a better document, maybe you can manage that better as well. The one thing just to leave you as well to think about a bit is a very robust document might take you a bit longer to do, but that additional time that you spend in providing the better information, it might actually help you to alleviate some of the scrutiny that might come from questioning. So there's two aspects here. The one is that all this additional information is required in a local file. And if you don't address those, call it items that you need properly, it's likely going to have more scrutiny. So you may want to spend, at least in the first couple of years on these files, a bit more time to address all the issues properly. And then hopefully you will have less questions because now the tax authorities are getting what they were after. Then the benefits of compliance. I thought here I put in the word transparency in the multinational. So you may be well aware of this as well, but what you see sometimes is that the subsidiaries within one company don't talk to each other much, or the one side thinks that they're just getting ripped off by the head office, and there might be other issues around that. But what happens when you do these files properly and everyone is part of this documentation process, because they have to be, because the local file is for each legal entity and the master file is for the group, you can actually see that the group in itself is talking better to each other, because now they're understanding that there is a service. They're understanding the service is actually beneficial. I'm not just getting a charge, and they also understand how this is made up, and it might make more sense to them. So this transparency within a multinational, and I'm not talking to trade secrets now, but the other elements that maybe sometimes a business doesn't talk about, can actually help you as well from a compliance perspective to have a more pleasant experience in this whole transfer pricing environment. Better risk management. So when you do these documents and you draft them, you might understand there is issues. And once you know there is an issue, you can actually solve the issue. A lot of times when you just do, or in previous times, you may not have been aware there were issues. So again, the local file is likely to go to show you that there might be certain concerns that you need to look at. The enhanced international trade relationships. So that's what I talked about already under transparencies as well. They go hand in hand. The better understand your global value chain, that's a very interesting one. And that is a topic on its own that can go on for many hours. But what I wanted to get there is that if you understand your value chain and you can see there's inefficiencies in that value chain, you can actually create a better value chain through the process of going through this compliance exercise of having a master file and local file. So don't just see it as a compliance cost and a wasted grudge purchase. But if you use the right people who can identify what's going on in the business and the value chain, they can actually help you to get things not just right, but also more efficient. So we've got some clients in South Africa who also use this opportunity to actually publicly have their CBCR in the financials. So Standard Bank is an example. They actually publish their country by country reporting in the financials annually. So I'm not saying that is where you need to go, but what these companies do with it is they're actually sharing their results, because they're sharing it with the tax authorities in any way, trying to say, listen here, everyone, all my stakeholders who are interested, we're not doing anything fishy or anything funny. So therefore, here's our country by country reporting. So there is also that benefit if you are into that kind of area. And then lastly, I just wanted to share some things we saw around the government perspectives, because you know everyone is saying how crazy are these tax authorities? How can they do all these things? But I think I just wanted to highlight. So when this came in South Africa, the South African taxpayers from discussions with SARS, our tax authorities, actually, you know, they are being compliant, they are filing on time, and it's actually making everyone's lives a bit easier. I know it's very hard to comprehend right now because it feels like there's a lot to chew off and do. But I did want to mention that, you know, once this does come right and we start talking to the authorities and the authorities are starting to understand our businesses better, because the master files are set up in such a way that they understand our businesses better, it actually results in more pleasant, can I use that word pleasant, you know, exchange of information and discussions, but I'm just going to leave it there. But I did want to raise that. So better information, as you see in the top right, there is also more focused discussions. We 5 to 10 years ago in South Africa had a lot of what we called or what we perceived to be phishing exercises. That is where a tax authority would just send you a 20-page letter asking literally for everything. That has kind of stopped. And now we're getting questions around, you know, you said this in your local file, why is that? Which makes it much nicer for everyone involved to actually tackle those issues that we know are there, or we maybe not know, but at least we can explain they are there, rather than having to go through 20, you know, boxes full of invoices and that kind of stuff. It is for combating tax avoidance. So let's just make that clear. The reason why we have this is because of the ethical issues around not paying the fair share of tax. I'm not saying it's illegal, but as you know, it's a big deal. Or certainly in 2015 or 13, when it came out around the BEPS action points, it was all about that we're not paying our fair share of tax. We have to maintain the infrastructure in the country, but we're not getting anything for it because you're just taking the money out of the country and all those discussions. So certainly we are here because of that. But it's also, I think, if you want to run a country, it is needed at the same time. And then the last thing, when you speak to the tax authorities, it's also something they have to implement. So you must also understand that tax authorities are a little bit in competition with each other, right? Kenya versus Tanzania, I don't know, South Africa versus Kenya, or Zambia versus South Africa. I mean, if you don't follow this, the question then is, why don't you do it? Well, then I'd rather invest my money somewhere else. So I think it's only time that the other countries, if they haven't followed yet, most countries have. You're part of the inclusive framework. Out of the 140 countries, I think most countries have implemented this, and it's going to just go there because it is global best practice, and we need to be competitive. And lastly, also, when people invest money in the country, they want to know it's fair. And by that I mean it's not necessarily that they need to do the files, but also that the competitors need to do the files. They want to understand that they're working in a fair environment. And that was my last discussion point. So I've said a lot. I don't know if there's any questions. I don't see much in the chat. But Steve, otherwise I'll leave it there. Or Magdalene.
Okay. Thanks a lot, Marcus.
Pleasure.
Okay, thank you so much, Marcus and Steve, for the in-depth discussion on the transfer pricing and the recent developments. So I'm going to bring in the practical aspect in it. What exactly are we supposed to do? Sorry for the inconvenience, sorry. So I'm going to bring in the practical aspect in the whole process. We're going to look at the filing process, specifically in Kenya. We're going also to see how do we evaluate related party transactions. We're also going to look at the transfer pricing cycle and what are we expected to do and what do we require in the execution of the whole cycle. So we'll also advise on what we can do or how we can support you in achieving your goals in terms of transfer pricing compliance. So earlier Steve mentioned something on country by country reporting notification and also the filing requirements. as per the Finance Act 2022, there was a requirement that you're supposed to file a notification with the KRA in the event you notice that you hit the mark of 95 billion. That is for multinationals who are operating in Kenya. So we're going to look at the whole process. What are you supposed to do in terms of filing the notification? And we're also going to have a practical filing, kind of a simulation on how you're supposed to do it online in the case where you have related party transaction. So kindly let me stop sharing my presentation, because I need to share the notification form so that you can see what is required, what information is required for you to fill in the notification form. So as you can see from the screen, for those multinational companies that have hit the 95 billion mark, you're supposed to fill this form and notify KRA that you are required to file the country by country reporting requirements as per the requirements by the law. So you can see this form, we have section A, whereby you have to identify your ultimate parent entity. You have also required to identify what was the starting period for the group reporting. What is the group, the start date and the end date of the group? It's like the period where the start and the end of the period, the financial period for the group. You also have to identify the consolidated group revenues for the group. And this one has to be specifically in Kenya shilling. We are also required, as per section B, we have to provide this information, whereby you have to identify the reporting entity. In this case, earlier we mentioned something to do with the surrogate, either a surrogate or a constituted entity, or maybe the ultimate. But there are exemptions for filing, which Steve mentioned, and we are going also to share, which are in this presentation, that when are we supposed when are we required to file the reporting, the country by country reporting? That one is contained in the presentation, and we can give. So, but in this case, that's why we have the reporting entity. You have to identify if it's the ultimate, is it the parent, or is there a surrogate entity? And then in the next row, we are supposed to identify we give the name of the filing entity, and we identify, or we have to give the tax number. So we have also to give the financial period for which we are going to file. For example, currently we are filing for the financial period 2022. So the start date for those companies that have start date of 1st January, then we'll have the start date will be 1st January 2022. Then the end date will be 31st December 2022. So we have also to identify where the country in which the reporting entity is, because there are requirements. If you have if the parent entity is in, for example, in Singapore, and is already filed the country by country reporting, then the Kenyan subsidiary or the Kenyan entity may not be required. And that's why we have to identify which entity is reporting. We have also to give the address and also where the filing will be done. So that is the form, and we have also another section whereby we have to show the reporting obligation in tax, where is there any country by country reporting obligation, like is there any tax pending or payable by the entity that is reporting in that particular country where they are tax resident. So we have also to identify, is there any competent authority agreement in force? between Kenya and that particular country where the reporting entity is, because you know that for those countries that have signed the mutual agreement for exchange of information with Kenya, then the entities in Kenya are not required to file the country-by-country reporting. So that one aligns with the transparency and exchange of information, and that's why there is if a country has already signed the mutual agreement for exchange of information, we do not need to disclose or file the country-by-country reporting, because the two countries can exchange automatically the information that they require or for those entities. So if we do not have, if already the country has signed that agreement, then you'll tick no, and then the KRA system or the KRA will now know that there is an existing agreement, and therefore you're not required to file. So you have also to identify as a company in Kenya, you have to identify yourself, which the name of the entity which is notifying. You have to put the PIN number and also the address, your physical address. So you can see for those resident entities, this section for complete the section for each of the multinational group entities who are resident in Kenya. If we have the constituted entity is the one which is reporting, then you have to put the information about the constituted entity. So we have section D, where we have to provide the contact information of the people who are filing or providing the notification. You have to give the email address, and you have to give a contact number for that case. So the last part of it is whereby you have to declare that you have issued the notification by signing and filling in the gap as per section E. So that is the notification form, which clearly is a way of disclosing to KRA that we are a member of a group, we are operating in Kenya, and this we are either filing or we are not required to file, or we have signed the agreement for exchange of information, we do not need to file, or our parent is filing. So this information is supposed to be filed and submitted to KRA before the start of the year, so that KRA will be able to know what expectation do they have about that entity. So that is the notification form. I'll take you through to the filing process in the event of you are having a related party transaction with your parent or your other related entities. So assuming your company is operating in Kenya and you have a related party transaction with your parent. So when you're filing your returns, the requirement is first, you have to file the master file. Number two, you have also to disclose, and you must have disclosed the information about the country-by-country reporting. And number three, you must also provide the local file. Now, for the sake of country-by-country reporting, we are required to file as we file our financial year returns. So in this case, when you go to filing of the financial year returns, then you have to download this form, whereby at the end of the day, you fill in the details about the PIN of the company, and you also fill in the details about the financial year that you are disclosing. But when you look at this form, there's a section for, do you have any related party transaction? That is, when you look at row number 23, you'll find that you are supposed, just a minute, I need to reshare. So apologies for that. So what I was trying to explain is what is the process of filing your related party transaction. So when you're doing your financial year end filing, you're required to go down into the iTax portal and download this form. Now, the key point is once you put your personal identification number or the PIN for the company, and you are required to go down and row number 23, where you're supposed to identify that you have related party transactions. So the moment you indicate the option, there are two options, there is yes or no. So you can choose either no or yes. So once you choose yes, then it will bring a tab down there for related party transactions. And this is, you can see the tab that is at B2, whereby now you're required to fill in all the details about your related party transactions. So let's look at this. So when you look at the first section, we have the name of the person you are related to. So if, for example, we have a company in, I've given an example in Singapore, the parent is in Singapore, and we have a parent in Kenya, then in the name of the related person, you have to identify here. So you are, after that, once you mention, then you identify what type of relationship do you have with that company? So is it head office? Is it by joint venture? Is it by control? Is it through association? Is it through maybe a liaison offices or representative offices? Through permanent establishment? Is it a subsidiary? So you choose according to your respective response. So the next one is about the tax residency, and this one you have to identify where is the tax residency of that related person. For example, if we have mentioned about a parent in Singapore, then we'll mention that the tax residency is in that specific country, like Singapore. So we will mention where the company is incorporated. Some companies are incorporated in different countries, but operating in different countries. And then in this part, we have to identify the type of transaction. For example, if you have intercompany loans, you'll put under financial services. If, for example, a company, for example, is in Kenya, is purchasing materials from a company, maybe in Israel, and then selling in Kenya, then you'll put under purchase of goods. If there is an issue relating to intellectual property, then you'll put under IP. So you select the description of the transaction depending on your specific details. So then you have also to identify, how do you compensate the related party? Is it through cash or non-cash? So that is how we are supposed to fill in, and then you have to put aggregate value of the transaction, but this specifically has to be in Kenya shilling. So the next session, you can see down there, we have part 2, whereby we are supposed to provide the financial performance of the local entity. So against the consolidated financial performance of the parent or the head office. So you have to put your details as per the balance sheet of the local entity and the balance sheet of the related party. So you've put in, for example, the total assets of the local entity. You also have to indicate the total assets of the parent. There, as you go down up to the total down there, total expenses, operating expenses, then finally you have to show the operating profit. So that is the financial information that we are required to disclose. We are going to share the slides. They also identify what information you are supposed to disclose in the CBR report. So we have the control transaction, part 3A, part B to 3A, we have to identify the control transaction that have given rise to the taxable income or the tax deductible expenses. So here we have to identify the category. So we have to describe, for example, in the category, it could be like we are saying, if it's a loan transaction, is it an IP, is it services, such transactions. So you have to describe the transaction here. For example, if it's financial support or financial assistance, is it an intercompany loan, or is it a credit facility that is existing? So we also have to identify the transaction. Is it purchase? Is it a sale? Such key details. Then we give the value of the transaction. And then if there are any transfer pricing and adjustment that have been made, then you have to highlight. Then at the last part, we have to show what method have you used to determine the transfer price. And part of this information will be used to justify whether that was the correct method. And that's why we are supposed to be keen in terms of which method we use for specific transactions. So we also have another section for control transactions that are capital in nature. And we have to give details as below. It could be intangibles or it could be tangible assets. You have to give the information as above. But down there, we also have to give the details of which amounts are due from, for example, if I would give an example of if we have an intercompany loan whereby we have been paying interest, how much interest is due from this company in Kenya, or in next the opposite of it is how much money is owed by the parent to the company in Kenya. So we have to give the information as below: how much was borrowed, how much interest has been given, what was the opening balance, are there additional amounts, and this brings in the issue or the requirement for us to keep loan schedules, especially, which indicates how much amount has been received, how much have been paid, and if there are additional payments, or are there any repayments that are due. So all this information will be required to input here. Those are borrowings. We have also current accounts, for example, accounts receivables, we have to disclose here, accounts payables, and all these will give the information of details about how much amount is owed by each entity to the other. So that is what we are. I'm not going to go further in terms of related party transaction recording or declaration in iTax. So that is specifically what you're supposed to fill in when you're filing your financial year-end returns. So it's a point to note that we are required to file the master file and the local file 6 months after the last day of the financial year end. So within that period is the same period that we are required also to file our financial statements. So it clearly means that we file our financial statements together with our master file and our local files. So that is the filing process. So I would go back to our main presentation slide. So kindly allow me to stop sharing this so that I share the slide, the main slide. So that is it about the filing process, about country by country reporting. So we're going to move next and look at what is the process of evaluating the related party transactions. And this is all about the TP documentation. So TP documentation has moved away from just documenting the process to a more of a practical approach, whereby at the end of the day, we want to arrive at the arm's length price. So, and the key, we start by first looking at the related party transactions. So when you look at your financial statements, you'll be able to identify what related party transactions you have with your related parties. Then from there, we'll look at the transaction, clearly try to understand it. We'll try to look at the financial flows. We'll look at the transactional flow, and then try to understand the transaction in terms of, is it a receipt of payment or a payment of payment? So in that case, we'll have understood the related party transaction, and then we'll know how to proceed with how to treat this related party transaction. So the next step, we'll try to understand the commercial or the financial relationship or the economic value of this related party transaction. Ideally, there are some transactions which may be material, and others will be immaterial. So a transaction may be immaterial to such extent that it doesn't warrant to be disclosed as a related party transaction. So in that case, that's why we bring in the issue about the commercial or the financial relation or the economic value of the transaction or the related party transaction. So okay, so sorry for this inconvenience. We're having an issue with the system, so kindly bear with us. So after we now identify your intercompany transaction, try to identify the financial flow and the transactional flow and also the materiality. Then we try to look at what are some of the supporting documentation that truly identify this related party transaction in your records. So in this case, we may look at, for example, in your ledgers, we may look at even your intercompany transactions, intercompany agreements like service level agreements, it could be loan agreements. And then we try to look at how do you compensate the other party for this related party transaction. And in this case, we have the OECD has provided a 9-step approach to treatment of related party transaction. And that is the same approach that we apply when we are trying to understand or to carry out that analysis. So the 9 approach in terms of, we have documented about master file. We have also documented about the local file. And these are clearly indicated in the earlier discussion that was shared by Steve. So we will be sharing the presentation and then you can see what is this 9-step approach that we follow, and what do we try to identify in these transactions. So in this case, once we now identify the transaction and we have clearly understood the transaction, now we have to test this transaction. What do I mean by testing? We want to see whether, depending on how you have described the transaction, is it the same way you are implementing it in terms of your operation? And now this is whereby we have to choose or select a method to test this related party transaction. There are different methods, transfer pricing methods, which have been provided by the OECD guidelines. And the common methods are about 5. We have the CAP, we have the transactional net margin method, we have the resale price, we have the profit splits, and we have the cost plus and all that. And then we apply that specific method depending on the characterization of your transaction. So it's not every method that applies to each transaction, and not every method that is so common, or it can be, as long as this method was applied to one particular company, may not be applicable to the other company, even if they have the same transaction, simply because of the nature of the transaction may differ depending on the details or characterization of the transaction. So that's why we have, for each transaction, we have to clearly identify a specific method that suits the testing of that related party transaction. Now, once we determine the method, now we have to apply the method to try to see whether is this at arm's length, and how do we come up to that? For us to reach at arm's length price, then we have to compare whatever you are, how you are treating the transaction, or you are applying, or you are determining your price, or your price with how independent companies are also determining the price. And that's why we carry out something we call the comparability analysis, whereby we are guided by 5 factors of comparability. We are going to see in the next slide. And now this one will guide us depending on the nature of the transaction and by the method we have used. Do we have related and non-related parties who are also using the same approach for the same transaction, and how much are they charging? And then that's where now we are able to identify, are you complying with the arm's length, or are you not complying? So apparently, that's where we have to do benchmarking process, which is a detailed process, and we'll be able to determine interquartile range, which gives a range of prices, or in terms of percentage of margins, or for the sake of the intercompany loans, a range of interest rates, whereby we have to choose the applicable interest rate. And now, once we determine the arm's length interquartile range, then we determine whether the range that is, or the percentage that is applied by the company is within the interquartile range. And then we'll be able to justify whether the company is compliant or is not compliant. In any case, it's not compliant, then we'll be able to advise, and also sometimes we also give other risks related to non-compliance, and therefore that's why we may issue a management letter for consumption by the company, and we go into in-depth discussion with the company to see how to remain compliant. So that is how we evaluate. Generally, we evaluate our related party transaction. So I have mentioned about the transfer pricing method, and you can see we have the CAP method, we call it comparable and controlled price method. We have the transaction net margin method, resale price method, the profit split, and cost plus method. So we also have our 5 factors of comparability. We may determine, we may use the contractual terms. For example, what are the contractual terms in the company agreements? We may also be guided by the functions performed. For example, for intercompany services, we are guided by what are the functions performed in that specific intercompany service. And these functions performed by the related party that we are in the non-related party that we are comparing with, and how is it compensated? So we may use functions, we may use contractual terms, we may use characteristics of property, and in most cases, this applies when we are using the CAP method, which is the most preferred method, before we consider other methods. We may also consider economic circumstances, also issues relating to geographical market, and also business strategies. For example, some companies may charge higher margins just because of their business strategy, maybe because they want to get into the market. The strategy is to get into the market, scheme, and get out of the market. So that is another factor we also consider when we are carrying out comparability. So now, we have talked about the compliance requirements, the new developments, and how we carry out the transfer pricing, how we file. But now, how do we implement this? Now, transfer pricing, before in Kenya, there was a requirement that you are only supposed to keep the documentation and just submit to KRA upon request. Nowadays, there is a requirement that you have to prepare and file it together with your returns. So in this case, it means then we must be able to implement the transfer pricing documentation. In this case, whatever we have documented in our transfer pricing report should reflect in our operations. And that's why we have come up with this process, transfer pricing life cycle activities, or a process which involves planning, we need to implement, we need to comply, and we also need to respond to controversial issues in case KRA comes in, or in terms of transfer pricing audits. So in planning, what do we actually need to do? We need to look at our strategy, and our strategy is to make sure that we design a transfer pricing document that is relevant. So we have to have whatever we have documented in our transfer pricing policy must reflect in our operations. And then how do we do this? We have to implement this in our pricing calculations, in our processes, in our procedures, in how we structure our operations, our group structuring, our operations, and all that. So we have to build in the whole, we have to build in the transfer pricing policy in our operations. Then after that is to run to see whether are we in line with that. We have to keep checking, like on a year end or after year, we have to keep checking whether we are compliant. Are we within our operations? Do we have new transactions? This will involve carrying out some calculations and depending on our records. So it is good actually if when we are preparing our financial statements, we also look at whether we have new transactions that have come up during that financial year that needs to be included in the TP document, so that we keep our document up to date and in line with our operations. So the other thing is we have to make sure that we post and settle intercompany amounts. For example, if we have intercompany loans and we have to pay interest to our related parties, and we just pause and we do not settle, we don't make the payment. This one brings a risk of exposure into deemed interest, which later, if it's deemed, then it will be it will involve, it will cost the company huge amounts, penalties, and also the deemed interest rate will be applied, which is maybe higher than the interest that you would have paid, and all those risks which have come along with it. So we have to make sure that we settle our balances accordingly, as per what we have disclosed in our transfer pricing policy. Then sometimes we have to make sure that we reconcile. At times we may, there are cases where companies may overpay or during the year they overpay, but at the end of the day they realize actually this was not the case. So it is good, depending on the standard operating procedures of a company, that we also set up procedures that align with the transfer pricing policy. If we are charging, for example, we are using a cost plus method for a certain transaction, then the payment should also reflect that we don't have to pay a fixed amount and then wait to reconcile. Either way, if we have to pay a fixed amount, then at the end of the year, we have to carry out reconciliation to make sure that we are aligned to the transfer pricing setup. So the other thing is the compliance issue. We have to make sure that we comply internally and also external reporting. We have to make sure that we are within the compliance requirements. If it's about filing the returns, and together with the master file and the local files, we make sure we file the country by country reporting. Then in the event of an audit, then it is good that we fast track the process and respond within the timelines as given by KRA, so that we avoid any related penalties or any risks that may come to that. And some of the issues which come in here is inability to provide information. So it's good if we have our documents in place and we have put all our processes and calculations in place, then it will be easy to respond to KRA audits. In the event of a request for information, we'll be able to provide, and we'll also be able to respond within time. So that is the transfer pricing life cycle activities we are talking about. But we should ask, what exactly do we need to have this? We have come up with four process, which is the people, process, data process, whereby, you know, we will need people. We'll need people. We need to come up with processes. We'll need to come up with data, and we'll also need to come up with that technology. I think Marcus in his presentation mentioned something to do with this, that all these items, they work together to ensure that we have a whole transfer pricing compliance process. So we need to have to make sure that we have brought on board all the stakeholders that are needed in the transfer pricing strategy, execution, and also in the defense in the event of an audit. For example, you may need a consultant in the case you need to be represented for a transfer pricing audit. And in the case of execution, most companies may not even have the expertise to prepare a transfer pricing document. So it's good we look at what do we need. We need people, we need all these stakeholders. And then in terms of this, we also need to bring in our collaboration between departments and also the whole process of transfer pricing. So in this case, Steve mentioned about something to do with the need to have people, or we need to have trained transfer pricing individuals or employees who may respond well in terms of transfer pricing issues. So we also need to ensure that our people are trained well to carry out such transfer pricing operations. In terms of the processes, we must ensure that we have a transfer pricing process that is in place, and there are people on it within the company who can just take on in case of an issue relating to that. We have to keep our data, and our data sources must be available in the event of any information requirements. Then at the end of the day, we may need technology to make sure that we run efficient in this whole process. So that's about the transfer pricing lifecycle activities. Then I would finish with what can we do and what can we support you with. In BDO, we'll be able to, we have enough team, or we have the resources to support you with the transfer pricing services. We will be able to support you with the transfer pricing documentation. We sometimes carry out transfer pricing health checks to make sure that you are compliant. We can also assist you with carrying out analysis to ensure that whatever is in your transfer pricing documentation reflects the whole operations, and in case of any variances, we'll be able to advise. So we also prepare the manuals, intercompany agreements, and we can also provide step-by-step guide on transfer pricing calculations. So other than that, I want to end here with our transfer pricing implementation team in BDO. And these are the team. You have Steve, we have Ida, we also have Archie here, and we also have other team members who we have not included here. So thank you so much. Thank you so much for joining us during this presentation.
Thank you all so much for joining this webinar. I hope you enjoyed it, and I'm sure you all learned a lot of new things. And as I mentioned previously, this recording will be uploaded on YouTube, and we'll also email you the slides for your reference, and obviously share it with your network and your contacts. And we'll be having a lot more webinars coming next year related to forensics, risk, tax, and corporate finance. So again, thanks to Steve, Marcus, and Madeline for your insights and your expertise. It's been a really great webinar and very helpful for all of us. We have a few questions. For those of you who have other commitments, feel free to leave, I'm sure, because time is kind of a constraint right now. So we have one question, maybe Madeline can take, or Steve. So the question is, can we read this question? Should I switch on the just switch on the video?
Thanks a lot, Magdalene, for that presentation and the practical elaboration of how this really looks in the return. That is quite important. Okay, so no, there is a question as to whether a provider of a service in a multinational context can present a different pricing method or arm's length outcome compared to the other, to the provider of the service. That's not possible. It's one transaction between two related entities. And so it's expected that the treatment is the same, or there is a selection of only one tested party. Either the provider of the service can be the tested party, in that you test its earnings against the earnings of other entities in the open market who provide similar services. Or we can have the tested party being the recipient of the service, where we check what kind of compensation are people providing in the market for that particular service. So it has to be the same. So when in terms of the FX losses, I believe this is a question on FX losses. So this is there is a formula for this, and it's going to be deferred for a particular period of time, and you also have to consider the requirements for FX loss disregarding, which are going to be shared with everyone. There is a newsletter which we are sharing together with this, which has all the details for everyone to be able to see. Okay. So I think my colleagues had earlier on responded to the other questions in the chat on the issue of whether you need to submit the master file. So these submissions are based on a particular request of information. So if you look at the law, if you look at the way the Tax Procedures Act brought it out, it has to be you file that particular return in the format provided by the commissioner. Now, the commissioner had not provided the format. So part of the format has now been provided in the iTax portal, and so you can see how it's populated. Maggie has just taken everyone through this. There are country by country reporting requirements and guidelines that have been published. So these ones are going to be automated as well in the system. So it will be from next year effectively, because there has been a delay because the process was not yet rolled out. The guidelines were not out. iTax was not updated to have these requirements in it. So from next year, the filings next year, these requirements are going to come in handy. But for now, upon your request, because the country by country reporting, there is an email portal, there is an email address that has been provided by KRA. You just take the country by country report in the particular format and you send it on email. So that in itself is the filing. You just take it, attach an email, and you submit. So yeah, so this is already systems go for most entities that are obliged to fulfill these requirements. So the administrative interface in iTax and how these returns are to be presented, the email to be used for CBC returns is already there. So these requirements effectively from where we sit, they are going to be most effectively implemented from next year. The other key point to note is that you need to take some time. If the filing for next year by June is still 6 months away, you need to take some good time to prepare it correctly. You've had Marcus sharing the experience from South Africa, and he said that it is better for people to take good time to do a good document than obviously to rush into the last minute culture, which may lead to wrong information going out, and that wrong information can be used contrary to the interest of the company.
Okay, thank you so much again, and thanks for your question. We've seen all your feedback in the chat, and we really appreciate it. I guess that's all for today. Thank you again, and thanks to our expert panelists.